Hello, all. We'll be talking about Forex history. What is Forex trading? Why are we trading Forex? Forex trading is the buying and selling of currency. Is buying and selling of currency. As an example, if somebody send money from me abroad, somebody send about $1,000 for me from US, and they build the fact dollar is not Nigeria legal tender, I will need to change that money into what? Into naira for me to spend that money in Nigeria. So by it's either I take the money to a booking on the street or I change the money in the bank. By so doing, I have done what we call foreign exchange. So it is buying and selling of currency. Buying and selling of currency. So let's talk about brief history of Forex trading. Okay, how exchange actually started from. Exchange started from what we call trade by barter. I believe we understand what trade by barter is all about. So before there was established system of currency exchange, there was a system known as not barter, the direct exchange of goods and services for each other. So what we call trade by barter, just like for example, if I have a sheep, you give me a horse. If I have a cow, you can give me a pig. If I have a camel, you can give me what? You can give me a bull as an exchange. So there's a trade by barter between one another. Then if I have a salt, you can give me palm oil. It's also part of trade and barter. If I have a yam, you can give me cassava. If I have trade by barter is just like exchange of what? Goods and services. These are the first set of words, first set of exchange that was I would even say it like it's an initiate set of foreign exchange. And I understand then during the colonial, before the colonial era, when Europeans came into Africa, the first what they did just like they did what we call trade by barter, whereby they used a matchbox, a complete match to take about 10 slaves from us. So the first set of exchange was trade by barter. It started around 600 BC. About 600 BC. What is the next one? The next one is what we call the commodity money system, which started about 1000 BC in a nation called Mesopotamia. What is commodity? Is a basic item used by almost everyone in society. Whether you are poor, whether you are rich, whether you are illiterate, whether you are lettered or learned, you must mix of what? Commodities. What are commodities? We have rice, salt, maize, beans, guinea corn, millet, sorghum, and so on and so forth. And so on and so forth. Even soya beans, and so on and so forth. So commodity money, the use of commodity for the purchase of other goods and services. That means you are using commodity to purchase other goods and services. Other goods and services. We have shekel, each shekel, 80 grams of barley. 180 grams of barley to buy so amount of things. Maybe 1 deca of rice to buy so amount of barley. Maybe let's say 1 pound of rice to buy 2 kg of beans. So these are the second set of words, second set of exchange. The next one is the precious metal. The kingdom of Lydia, which was located in early part of modern day Turkey, is credited with producing the first coin in 70 to 650 BC. They are the first economy. They are first manufacture the first coin for exchange. They are, I would actually say they're one of the advanced economy then. They actually what manufactured the first coin. And the coin were marked according to their respective weight. And the name of the coin will denote their weight. The coin were marked according to their respective weight. And the names of the coin will denote their weight. So, for example, if I produce a coin, a silver coin of 5 kg or 5 pounds, definitely that silver coin will be 5 pounds sterling. It will be 5 pounds sterling. If I produce a gold of $5, so definitely that gold will be 5 USD dollar, because the weight will determine the values of that coin, the amount of the coin. Then next, we have the floating system, free flow system. When we talk about free flow system, whereby you leave the coin, you leave the currency to float, to move according to the price of forces of supply and demand. That means the force of supply and demand will determine the value of each currency pair. Will determine the value of currency pair. The force of demand will determine the value of the currency. If you look at it, a floating exchange rate is a type of exchange rate regime in which currency values is allowed to fluctuate according to the forex market. According to the forex market, that's according to the forces of demand and what and supply. And in the modern day world, most of the world currencies are floating. Most currencies are floating. I'll give you an example. Let's say we have about 10 investors coming to invest in the Nigerian economy, and they want to invest in rice. Okay, and each of the investors is bringing about $1 billion for investment in rice in Nigeria. Then we will have about $10 billion coming to the Nigerian economy. The first thing that will happen is just like there's going to be a high demand of what? Demand of Naira, which make Naira scarce and make that what? Naira to appreciate. So which means we have large volume of dollars running after a small amount of Naira. Okay, it will make the value of Naira what? To appreciate, to move up. To move up. So force of demand will determine the value of a currency, determine the strength of that currency. Okay, and if the vice is the case, for example, we have large amount of Naira chasing low amount of dollars, definitely the price of dollar will appreciate against Naira, just like what we're having in an economy, in the Nigerian economy at the moment. So the new system is based upon the market forces of the supply, and as I said earlier on, it is based upon the market of forces and demand. It allows for central banks to intervene in order to work to prevent sharp changes by the manipulation of the world of interest rates. What is interest rate? Interest rate determines the strength of a particular currency pairs. As time goes on, I will talk more about interest rate. When we get to what we call fundamentals analysis, I will talk more about interest rate, how increment and decrement interest rate affect a particular economy. You can supply and demand, how it affected a currency. Then in 1973, online forex trading was only available to banks and large corporations. Banks and large corporations, which means if you don't have about $1 million, you cannot trade forex. If you don't have $1 million, you can't trade. And moreover, if you're not a large corporation, just like Bank of America, just like Bank of Japan, Bank of Australia, Coca-Cola, Chevron, the big guys, you can't trade forex trading. And trading was carried out over the telephone via several exchange centers all over the world, which means if you are placing a trade, you need to pick a call to your broker. For example, if I want to pick Euro USD, I need to call my broker and tell them, my broker, I want to sell Euro USD at a particular price, place the trade for me on my behalf, and they will do that. And you have to go through exchange, through phone call and exchange. And also, transfer of funds to complete a trade was done through bank transfers, which often took a few days to go through. I can remember my first deposit about 15 years ago with FXCM in US. It was through transfer. I think I deposited about $1,000 into my bank account, my dom account in Nigeria here, and I asked my bank to move it to my trading account in US, to my forex broker account in US. It takes about 3 to 5 days before money could get there, and even after the money get there, I was charged about $50 from the money. So at the end of the day, I received about $950 for trading. Imagine between the pace of that 5 or 3 days, I will have made good money from some of the trades I will have seen online. So that means that Forex trading market offer a fantastic earning opportunities. Trading was both timing, consuming, and so hazardous. So it has a lot of fantastic earning. You can make a lot of money then. You can make several amount of money then, but it was both both time consuming, and it takes a lot of hazards. You have to go through a lot of rudiments before you can get your money to your trade to your brokers, and also get your trade calls back to your brokers. Then you can imagine then when there's disrupt of a rainfall, when there's a rainfall, thunderstorms, whereby you can't call your broker, definitely you've lost a lot of money. But in 1994, online Forex trading made a debut with the first online Forex transaction done. At this time, it became available to individual speculators. That is when people like us who have a small amount of money, then we have the advantage of what? Joining people who want to trade Forex. Okay, then our little amount of money then can also help us to push into the market and trade money. So with the advent and the then increasing popularity of the internet, online Forex trading opened up the doors to millions of people who had never previously had the resources to take part in it. Internet make it more visible. Internet make it more easier. Internet make it more easy for people to trade. Okay, during the earlier days, there's something called internet. There's internet, but internet is actually meant for the rich people, those who have money, for the affluent people. But with the advent in the early 90s, when internet becomes more popular, training also become more popular, and it become more flexible. Then we have a lot of people coming on board, millions of people coming on board to join trading. This was the period in which brokerage firm come on board, and through brokerage firm we can access the banks. We can put our trade to the banks because they are more or less intermediary between we and the banks. They start a middleman between the traders and the banks. So whatever trade you pick, the brokers route it backwards to the banks through what we call leverage. When I get to leverage, I'll talk more about leverage and how leverage actually helps us in what in and actually help us to be able to trade with small amount of money. Then why trade currency? Why trade currency? So let's move. One, it is the world's largest market. Two, easy to understand. Three, trade at home from anywhere. Four, low transaction cost. Then five, high leverage than shares. The first one is the largest market in the world. I call it the most liquid market in the world, the most traded market in the world, the most liquid in the world compared to any other market in the world. We have the London we have the London stocks, we have the Australian stock market, we have the New York stock market, we have Japanese stock market, even the Chinese stock market is combined all together is not as large as the Forex market. It is the largest. Foreign exchange is the world's largest and most active market. It runs 24 hours a day, trading starting in Tokyo on Sunday night, 21 GMT, that's around 10 p.m. Nigerian time here, and close New York on Friday evening, the same around 10 p.m. Nigerian time. For around 5 p.m., when banks are closed in New York time, you see the volatility become thin and also become low. So you don't see much activity coming up in the market anymore. Okay, so if 4 to 5 billion a day volume in Australian stock exchange was a swimming pool, then 7 trillion a day Forex market will be an ocean. Because for every day, about 7 trillion is being transacted. Every day, about 7 trillion is being transacted. You keep asking me, why 7 trillion? Why would they get 7 trillion? 7 trillion is not being centered, it's not being centered upon an individuals. It comprises the company, the banks, the company, the banks, the company, the bank, the central banks, company, banks, central banks. Then we have the hedge fund. We have the hedge fund who carry the majority of transactions online. we have the hedge fund, then we have people like us. Those who want to have a lot of people, those who want to travel out of countries, maybe they need to buy and sell a particular currency pairs before they can go. So these are the accumulation of people that amounted to that particular $7 trillion. For example, let's say we are looking at like a company in US who want to procure a vehicle in Japan. Okay, Japan is more or less a world an export-oriented economy, and we have a company in US who want to go to Japan and get a Toyota car. So which means they will need to what? Buy Japanese yen, use the dollar they have a chance to buy Japanese yen before they can what? They can buy the cars they are getting from Japan. Okay, just like as I said earlier on, investors coming to Nigeria, breaking their dollars into Nigeria economy. So which means they're coming down to what? To buy naira from us. Okay, before they can go ahead, buy land. By buying land, they are creating what? Creating an employment. After buying land, they start producing rice. After producing the rice, they start selling rice, which means people will bring their idle currency to Nigeria to buy rice from Nigeria, just like we're buying rice from Thailand and the rest of the world, Thailand and Indonesia. Okay, this is exactly the way it actually works. This accumulation of several transactions across the whole globe, across the whole world, that amounted to that $7 trillion a day. A day. Then easy to understand. Easy to understand. The learning curve in shares market is very steep. Learning curve in share is very. So as I said earlier on, the learning curve in shares market is very steep. So we're trying to compare the difference between shares and the Forex market. Okay, in shares, the learning curve in the shares market is very steep. It's very is a little very deep. With stock market, the amount of analysis required and is being required. With stock market, the amount of analysis required can be overwhelming, which means you need to analyze a lot of things. You have to put a lot of things into consideration before you can go ahead and buy a particular stock. For example, you need to understand the dividend of that stock. Secondly, price earning ratios. Third, the takeover. Fourth one, quality of corporations management will determine also will decide which shares are likely to move up in which direction. So those are the things you need to look before you go ahead to buy a particular shares. But in Forex trading, it doesn't work that way. You can pick a particular currency pair, analyze it, and place your trade in it. And in Forex trading, you can buy and sell simultaneously. But in stocks, you cannot. In stock market, you cannot buy and sell at the same time in stock market. In stock market, what you need to do is just like you buy at a particular price, waiting for it to appreciate. And it could take some years, it could take some months for it to appreciate before you sell it back. But in Forex trading, you can buy and sell at the same time. But thank God for internet, stocks now is now online. That can call it CFD, Commission for Differences. You can also trade stocks online now. You can buy and sell stocks at the same time now, sometimes in Forex market now. CFD, you can buy Facebook shares, you can buy Google shares, you can buy Coca-Cola shares, you can buy McDonald's shares, okay, simultaneous also now. Also, so it make it more easier to do. Then by comparison, the foreign exchange market is relatively straightforward. It is what? It is straightforward. As I said earlier on, you take a currency you are familiar with and relate its value against other currencies. You take a currency you are familiar with and you relate its value against other currencies. You can trade it anywhere. You can trade from anywhere using your MT4 platform. You can trade it anywhere, any part of the world, in as much as an internet connection using what we call your MT4 software platform. All you need is just like your computer and internet connection. It could be your computer. If you don't have computer, you can use your mobile phone now. You can that be an Android, iPhone, and the rest. So even on the road, you can start to place trade. Even while you are working, you can start to place a trade, you continue your work, and you watch your trade, how it actually unfolds. So the advent of internet make it more accessible, and it make it more easier for you to trade it everywhere, day in, day out, 24 hours a day. It's not say day now, 5 days in a week. Then Forex has a low transaction cost. Forex has a low transaction cost. In Forex market, the cost of trading currency is determined by the spread. The cost of trading currency is right by the spread. And spread is different between the price at which trader can buy a particular currency that is asked and the price at which they can sell. So spread is different between bid and ask in a nutshell. It's a difference between bid and ask. The spread can vary from as low as 5 pips for high volume major currency to 5 or minor pips for minor currencies. In Forex trading, we have what we call the major currency, we have the minor, then we have the exotic currency. Okay, so forces of demand will determine the transaction cost of a particular currency pairs. Okay, we determine the spread of a particular currency pairs. For example, now USD is one of the most traded currencies in the world. The transaction cost is always very, very low because we have high volume of people demanding for it. So the cost become more cheaper in world during the Euro sections. But when you get to the Asia sections, where we don't have more people demanding for it, the spread become more higher. Okay, and for example, let's compare Euro USD against US dollar against Saudi Arabia Riyadh. Nobody trades Saudi Arabia Riyadh. So definitely the transaction cost will be on higher side because the demand is very, very, very low. So Forex has high leverage than shares. Then what is leverage? Ability to use a small amount of money to control a large amount of money. That's leverage. You know, I said earlier on, when FX actually started, you don't have $1 million, you can't trade Forex. Okay, but when broker came into place, it come on board in around 1992. The first thing they did is just like they give us a leaping app, they give us a leverage, just like they give us a virtual loan. It's a loan given by a broker to assist a trader to go into the world, to go into the banks. Because with a little amount of $100, there's no way you can meet up with the big guys trading. With the financial institutions, with high financial institutions, then with the big boy, there's no way. So what they do is just like they loan us. They loan us some amount of money for us to work to leapfrog into what? Into the market. Okay, just like electricians who want to fix a pole. And for him to climb that pole in the ladder, that ladder is a leverage for him to get to where he's going to repair what he needs to repair. So leverage is what? It's able to use a small amount of money to control a large amount of money. So broker will give you the maximum leverage of a share market is usually 20:1. 20:1, which means your contract is 20 times the initial margin. So for example, if you deposited about $100 and you are giving 20:1, you are giving 20:1 to start with as a leverage you pick. So definitely your $100 will be times 20. So it means you are using $2,000 to do what? To place your trade virtually. You are using $2,000 to trade virtually because broker does not know you, they don't know where you have come from, and they cannot afford to lose the money they borrowed you. They will not ever lose the money they borrow you. Immediately, your money is below the amount they borrowed you. They will remove their own money, and you see what we call the margin call. You will receive what we call the margin call. Then we'll tell you go and add more capitals to your money for you to start trading again. So on the other hand, the maximum leverage in the Forex market is 1,000:1. So definitely, if you pick 1,000:1 and you funded with $100, that means you are using close about almost $100,000 to trade virtually. But remember, your money is still $100. Leverage is a two-edged sword. Leverage is two-edged sword. The way you can give you more money, also the way it can make you to lose your money also. So foreign currency, Forex trading, how it works. How did it work? How did it work? What is Forex trading? What is Forex market? How Forex prices work? What is Forex trading? The trading of currency from different countries against each other. As I said earlier, foreign currency is buying and selling of currency, or you can say the trading of currency from different currency against each other. In Forex market, currencies are always quoted in what? In pairs. Currency are quoted in pairs. We have AUD USD, we have GBP USD, we have USDT PY. Then each currency has a universal three-letter code called ISO. Called ISO. All foreign exchange participants used for identification. That ISO, that all foreign exchange participants use for what? Identification, just like Naira now. Naira now, we have our own ISO. For dollar is USD. For Naira is NGN. Naira is for NGN. USD, we have US for dollar. For pounds, we have DPP. For euro, we have EUR for euro. For Switzerland, we have CHF. Okay, as much as possible. For New Zealand, we have NZD. For Australia, we have AUD. That is their own ISO code to denote their currency. What is Forex market? It's a global trade network of financial firms, banks, multinational firms where over 7 trillion is traded 24 hours a day, Monday through Friday, from New York to London, Tokyo, and Sydney, and every other world financial centers, including Nigeria. I said earlier on, before we get to these levels, that about 7 trillion is being traded every day. By what? By the financial firms, the bank, the multinational firms. About 7 trillion is being traded every day, 24 hours a day, 5 days in a week. Major currency pairs. The time major currency pairs used to refer to the 7 most liquid, that's most traded, most actively traded currency in the market. These 7 ones are the most active, most traded among all pairs. That's what we call them majors. We have the US dollar, we have British pounds, we have euro, we have Japanese yen, we have Swiss franc, we have Canadian dollar, we have even 8. We have Australian dollar. It's not inclusive here. We have the AUD. It's 8 of them. It's 8. We have US dollar, British pounds, euro, Japanese yen, Swiss franc, New Zealand, and Australian dollar. And each of them, as time goes, I will group them into groups. We have the commodity currencies. We have the safe haven currencies also among them. For example, now we have Canadian dollar, New Zealand dollar, AUD, USD. They are commodity currencies. Canadian dollar is being determined by the price of crude oil. Okay. Australian dollar is being determined by the price of iron ore. New Zealand is determined by the price of what? Price of daily products. Okay. When we get to fundamentals, I will talk much more about that also. The major currencies, we have the minor currencies. They are all currency other than major ones. The minor currency that are other than the major ones. Then I said earlier, commodity currencies are those who own country rely heavily on commodity exports. I said earlier on, for example, before I get to this place, I talk about the commodity currency. Those are those whose own countries rely heavily on the commodity export. Major pair are the 7 most. We have Euro USD, blah blah. We talked about earlier on AUD USD and the rest also. So how Forex prices work? How Forex prices work? By Forex prices work. Exchange rate, that's currency are traded in pairs. Then we have the codes, the base currency, and the quote currency, which goes the exchange rate. Exchange rate. Base currency versus the quote currency is what we call the exchange. You see the base currency here. Base is always on the left hand side, then quote is always on the right hand side. Then that means one Aussie dollar or one AUD can buy 1.2820 US dollar or USD. Okay, you can see it here. So when the charts go down, so does the base currency also go down. So when the chart goes up, likewise, the same thing. You can see it. When that goes up, so does the base currency also what goes up. Then pips. I would say pip is the smallest increment in price. What is pip? Well, most of the time we start making mention of pips. How many pips do you make? I make 10 pips today. How many pips do you make? I make 20 pips today. Just like in the signal group, I could say today I make 20 pips today. I make 30 pips today. I make 40 pips today. Pips is the smallest increment in price. Also, we can also say that the unit of measurement to express the change in value between two currency is called a pip. A pip. Most PL goes out to 4 decimal places, but there are some exceptions like Japanese yen. They go out to what? 2 decimal places. Okay. For example, now if I bought euro at the rate of maybe 1.2242, I bought it, and price moved to 1.2247. Definitely, I've earned what? I have earned 3 pips. 3 pips. But the value of how much I actually earn will be determined by the volume I used in trading it. The volume will determine the amount I earn in the currency I deposit with my broker. So in a nutshell, pips is what is the smallest increment in price. It could be positive, it could be negative. Let me give an example. Okay, somebody send money from me from Europe. Let's say about $100 from me to Europe, and you need to go. You need to from abroad, and you need to go to the booking man to change the money. Okay, and you get to the booking man, and he said the exchange rate is 700 naira per dollar, and you felt cheated. And you decide to do what? Let me just relax. Maybe about 2 or 3 days, I will come back. Or getting there after 2 or 3 days, price have increased to about 710. That means you earn what? You have earned about 10 pips. 10 pips. So if actually you are selling $100, that means you have earned extra 10 naira. 10 naira on the previous amount. But peradventure, when you get there, instead of being 710, becomes 690. That means you have lost 10 pips. So pips could be positive, at the same time, it could be what? It could be negative. So making pips is making money. Pips are worth money, so you must collect them. And there are two ways to collect pips. 2 ways to collect pips: by buying, at the same time by selling. Those are the 2 ways to do what? To collect a pip, either by buying or by what? By selling. If you want to buy, which actually means buy the base currency and sell the quote currency. You want the base currency to rise in value, then you could sell it back at a higher price. So just remember, long is buy, then sell is short. So if you want to sell, which other means sell the base currency and buy the quote currency. You want the base currency to fall in value, then you do what? You buy it back at a lower price. So overview of technical analysis. I'm going to stop today, and next time we're going to look at the overview of technical analysis. Then, for example, what technical analysis, we talk about main analysis method, main analysis assumptions, purpose of Forex analysis, then types of charts. And those are the things we're going to look for in the next class. Thank you so much. See you in the next class. Have a good reading.